Welcome back to the new video, and this is the first video of the playlist where I will cover all the chapter in the of book option future and other derivative by John C. Hare. And this will be the introduction to the quantitative finance and the derivative world. And the playlist will consist of 36 videos representing the 36th chapter of the book, and we are continuing with the 11th edition of the book, and I hope you like this playlist. So let's start without any delay. So to understand the quantitative finance world, we will just start with the finance derivative like a stock market. There is a money market, and there is a different type of market. There is a different type of market. So one of the is the derivative market, which is the part of the whole financial market. And now we will see the chapter introduction to derivative or introduction of this book. So let's start it. Right. So what do you mean by derivative? So to understand a derivative, you can assume that derivative is a financial contract whose value is derived from underlying asset. Uh, so what do you mean by derived from? Derived from underlying asset. So asset is anything that is valuable, right? So asset can be stocks, commodities like gold, silver. So the derivative value. So there is a stock derivative, commodity derivatives, and many things. So the price of the derivative will depend on the price of the underlying asset. In this case, stock, like 100 rupees. If the price of the stock increase, the price of the derivative also increase. You get the sense. So derivative has grown popularity, like derivative has grown increasingly important from past 40 year, and it is among the most important market of the finance and $1 trillion market. So so what are the derivative? There are many type of derivative. So few I will list for you. So there are futures, option or forward, option, swaps, bonds, credit default swap, interest rate bonds, and so on. So there is a hundreds of a derivative product, but in this chapter we will mainly cover two type of derivative, option and future. So before understanding this derivative, we have to understand if we have a derivative, we have to trade. So we have to go into market, find the person who is willing to buy the derivative and make the trade, like trader A and trader B, and they will trade the derivative. And this type of market, this is market is where is a place where a buyer and seller meet to exchange good, and in this case the good is a financial product, right? So let's go and see exchange traded market. Exchange traded market. So you all have heard about stock market. Stock market. So derivative exchange are the exchange where we trade derivatives. Simple. So there is a trader one and there is a trader two, and they trade derivative in exchange traded market. And good thing about this market is the derivative is regulated by the exchanges. So there is so much regulation, like in India, derivative market is regularized by SEBI, right? And so the market, the trade in the exchange traded market don't happen directly. Yeah, it of happen direct, but in between there is a clearing house, right? So the whole purpose of the clearing house is to ensure that none other party defaults. So if the default, then the market will grasp that. So the clearing house, like in exchange trade market, so clearing house makes sure that none of the trader default, then to make sure that they correct the upfront money, and that money is called margin. And in the account in which margin is paid is called marginal account. So each trader have to maintain the marginal account and have to uh, maintain their margin as per as their trade. And this is how the exchange traded market work. And the example of one exchange traded market is CME Group, Chicago Mercantile Exchange Board. And many option was created. Okay, so uh, now we go to electronic market. Sorry, electronic market. Electronic market. So as if you have watched, sorry about that, if you watched the series Harshad Mehta or Scam 1992, you have seen the stock exchange floor, and they trade using the hand singer, and that system is called open outcry system. And the problem with that system was it was very chaotic and unorganized. And to as the computer advance and the technology become more suitable for the financial market, all the trade is happen is all the trade are done by computers. And these computers gave birth to we all know as HFT, high frequency trading firm, and also the algorithmic trading, where you use computer algorithm to trade without any human interaction or minimum human interaction. That is a yeah. And so if we consider market, there are exchanges, and there is OTC, over the counter market, right? Yeah, this is two binary type. And now we will see OTC market, right? So consider that OTC market is like a private market where the name suggest over the counter. So you can imagine a table where the corporation 1 is there and the corporation 2 is there, and they are creating their own personalized derivatives uh, tailored to their need. And the trade is happening between them. So this is the basic sense of the OTC market. But here the table, the most of the you can consider table as an investment bank. So the investment bank is in between the corporation 1 and corporation 2. They create the derivative, they price the derivative, they tailor both corporation need. And you can that's why investment banks and major banks are considered as a market maker in OTC market. So they are the market. The corporation have to go to investment banks to trade, and the participant of the OTC market are big governments, big corporation, banks, investment banks, hedge fund, and you get the idea. So it is OTC market, but like uh, like in exchanges, uh, the trade, to prevent the chance of default, there is a CCP, center counterparty. It acts as a clearing house in exchanges. So the whole purpose of CCP is to ensure that none of the party defaults. So it is like a clearing house for that. And now we will see one. There is a one business snapshot of about Raymond bankruptcy. It is very nice. It is very nice snapshot, and you can run. But here we will run about the snapshot that cover systematic risk. So everyone note financial, yes, crisis of 2008, and you all know that some of the big investment firm was brought, their debt was paid by the government. So why? Because so let's understand the concept of systematic risk. So in the financial market there are many participants, and many banks, let's say there is a bank A. Banks have a trade with bank B, and bank B have a trade with C, and C have a trade with both of them. Or there is D with have it is like a web. Each banks have a trade with many bank, and it is in big amount, not a small amount, in billions of dollars. So if for some reason A default, there is a highly chance, because of the uh, uh, d- uh, because A default, the B will also default, because there is a trade between them. And if B defaults, then there is a highly chance that C default, because most of the bank defaulted. So it is like a chain reaction. If the one bank defaults or go bankrupt, all banks may go bankrupt. And to prevent that, there is a constant concept of systematic risk. So let's understand the market size of OTC market and the OTC market and exchange. The market size of OTC. So OTC market is around five, right, 558.5 trillion dollar. So it is in high volume and the biggest market, trillion dollar. And the exchange market is around 98 trillion dollar. So you can consider OTC market somewhat 5 times bigger than this market. You get the idea how big the OTC market is. OTC market 550 trillion, 100 trillion. Or you can now, let's come back to the derivative section and understand uh simple, very simple type of derivative, that is forward contract. So it is the first derivative we gonna run, and let me explain you with the example. Okay, consider consider you own an airplane company. You are the owner of airplane company, and for simplicity, the all operating cost is just the fuel cost, because the fuel is a major part of the fuel is a major part of airline businesses. So major all the business cost are fuel cost, and the rest is the profit, right? And as we all know, and this is oil, oil refinery or oil company. You can understand that. And they trade oil in a large amount of barrel and large amount. So let's say airline industry, let's say your airline generated a revenue of 100 rupees in a 1 month, and the all operating cost is just 80 rupees, and for simplicity we are taking 80 rupees. Then the net profit you earn is 20 rupees for a 1 month. But as we all know that oil price is stochastic, that means it changes over the time, it is never constant. So what if in second month it goes up to 85, it is 15, what if it go even more up and it is 10, and likewise you get the idea. What if it go down, then there is a profit. What if it is go very up? So no company would every company love the steady cash flow in their businesses, and this is risk for the company because they don't know how much profit they will earn that month or that quarter. So to what we hedge this risk, to undermine this risk, we will create a forward contract. And here is the definition of a forward contract: is a contract uh, that allow a buyer to buy some certain goods at certain amount in futures. So for example, we have a trader one, and there is a forward contract of 6 months of oil, let's say oil, and the contract say that you will buy uh, oil at the price of 82, and we will deliver this after 6 months at the price of 82 only, no matter what is the current price. If the current price is 80, then you will get it at 82 because of the contract. If it is 70, you will still get the oil at 82. That is a forward contract. And the important terminology is the, so 6 month is a expiry date or expiry duration. Okay. And 90 or current price. So current price is called spot price, and the price at in the contract, the price that is written in a contract is strike price or contract price, right? So let's take this example. So we have a oil, and you own the airplane company. You know that in 6 months you will need some amount of oil, right? In 6 months, so you will go to oil company and say that uh, today's oil price is 80. Okay, today oil price is 80, and you will tell the refinery that I will pay 82 rupees now, and you will deliver me in 6 months at the price of 82 rupees only, no matter what is the spot price. If the spot price and the airplane company have their own analysis and know that the price will increase in futures, and so to hedge that, they created a forward contract at the price of 82, and now the after 6 months the current price of the oil is around 100 rupees. So the net profit by giving by creating a forward contract is around 18 rupees. So that is the main benefit of the forward contract. And now we will see about forward rate. Okay, so this was the example of, let's say, so let's say uh, okay, sorry, we are on the wrong slide. So here we have to clear some terminology like airplane is trying to forward contract, and so that's why who is buying is called is in the wrong position, wrong position, and the person who is selling the contract is in the short position. Just to remember, okay, wrong and short is clear. Now let me see the this is table 1.1 from the book, which is the spot and the forward code for the exchange of USB and Great British Pound. So it is a currency exchange forward, currency forward, and the bid and ask price are this. So what is bid and ask price? So ask is maximum, sorry, minimum a seller willing to sell. This is the ask price, and the bid price is maximum a buyer willing to sell, willing to buy at this price. So bid is the highest buyer can pay, and ask is the minimum they minimum or right minimum the seller want for their contract. So there is a 1 month forward contract, that means the expiry is in the 1 month, 3 month, and 6 month, and you will this is the currency exchange rate. Okay, so like we say forward rate. uh, so here you can so here you can see that the airplane company hedge their risk. So it is a type of hedging used by done by the forward contract. So they hedge their position. So likewise we can also hedge using this price. So for example, in book there is May 2021, currently it is May 2021, May 2021, and the foreign currency, we have to hedge the risk of the exchange, what we say, exchange rate. So we know that we need a 1 pound in 6 months, 1 million pound in 6 months, and we have to hedge this situation. So 6 month forward ask price is 130, so 1.3. So trader is agree to buy pound or dollar into at this rate, and it will be hedged. If the price increase to 1.3, uh, then it is profit for the treasurer. Now we will see the payoff payoff of forward contract, right? So it is simple and logical also. Wrong forward contract, the wrong position payoff is ST minus K, where ST is the spot price and K is the strike price of the contract. And in the case of oil 82 was the uh, K, and uh, ST was 100. So payoff was 18, right? And for a short position is K minus ST, and the short position in the transaction was your airplane was the yeah, oil company, right? So payoff is K minus ST. So K was 82 and ST was 100, so it is minus 18. So oil company took loss in this trade, right? You can see that. Now we will draw the chart of it. So it is spot price and payoff, and then it is K. So for wrong position, this is payoff. So you can consider it 82 K, and the spot price increased to 800, right? And here was the payoff 18, 15, 10, like this. This is the of wrong position, and the short position payoff is, and we are, it is very bad, right? Here is K 82 and here is 100, and here is minus 18. So this is the payoff diagram of a forward contract, right? Now let's say let's see future contract. So future contract. Future contract is same like a forward contract, which is traded on an exchange and regulated by the exchange. That's it. There is a no difference between anything that this. So it is traded on few exchanges and regulated by exchanges, and the famous exchange are CME Group, Chicago Mercantile Exchange, right? That is the future contract. Now let's consider one of the let's see one of the most important uh like derivatives is option. So like a name suggests, let's take our old example. This is oil company and this is airline, and they are in the option is little bit modified version of forward contract. I will say what is modification. Let me take to this example, right? Oil oil company, we drafted a 6 month forward delivery uh, of delivery at a cape of 82, and the spot was 6 month earlier was 80, and in best case scenario the spot was 100, the payoff was 18, right? What if market crashes and the price after 6 months is only 70? Then you will lose minus 12 rupees on this transaction, right? So to right say to change that, we will buy a option. The option is a forward contract that give obligation to buyer to execute or not. So it the buyer is not obligated to execute at expiry, right? So if it was an option, and this option sorry, so to enter into the option market or to have the option, you have to pay premium. You can see it is option fee, and like in forward contract you don't have to pay any premium, but in option you have to pay premium upfront. Like if we bought option at the price of 82, let's say we pay premium 4 rupees, and the price go down to 70 rupees, then we will not execute it. So if we execute it, the payoff would be minus 12, right? The loss would be minus 12, but we will not execute it, so our loss is only the amount we lose as a premium, to minus 4 rupees. That is better than the losing whole amount of minus 12. So that is the option. And now let's see what is core option, right? uh, the core option give the holder to right to buy buy something in future, but it is not obligated to. I am So core option give a buyer right to buy something at uh, something at some price, and the put option give the seller to right to the option sell the product. A put option give the holder the right to sell the underlying asset by certain date for a certain price, and it is give the right to buy. And you have to remember that it is a right, but we are not obligated to execute it, right? So on exchange trader market, so we buy a, a contract, a one option contract consists of 100 shares. So this is called lot size or bundle. You can say anything, like. And now let's see the type of option. So there are European option, American option, Asian option, right? European option. You can exercise option on the expiry date only. That is the whole different. So if the expiry date is 20 December, you have to execute or not execute on that day only, 20 December only. You can't execute in between, like say 10 or 5 November, anything. But in American option, you can execute at whenever you want. There is no obligation to exercise it at expiry date only. So you can execute on 10, 5, whenever you want. And the Asian option is a complex option, and it is tailor made for the user, for the buyer of the option. That is Asian option, right? mm. So I think I covered the. So let's see a very important thing. So this is the bid and ask price of the option of a Apple stock on May 2020, and the current spot price is 316, which is between this, right? So this is the core option, it is the put option. So you the first observation, you see that there is a different delivery dates, and this is the premium charged for the option. This all, and this is the strike price, and the premium at this price. So first observation is, the longer the expiry date, higher the premium, right? See, June option I have a premium of $30, 40 and 47, and you can see it follow a pattern in all, regardless where it start. So you, because of the thing is, it is related to volatility. We have much time, so it is high probability that it can reach certain strike price. That's why it is high premium, right? And this, and you can see that how, as strike price increase, as the strike price increase, the premium go down. So you will so you will notice that the price of a call option decreased as strike price increase. So as a strike price increases, the price of a call option decrease because it is not very likely to go that much high. So and if we take the same condition of put option, as a time increase, the expiration increase, the premium also increase, and thus the strike price sorry, and thus the put option increase, uh, the premium increase as the strike price increase, right? Sorry, the core option, the price decrease as a strike price increase, and the um, input option premium increase as a strike price increase. It make a lot of sense. Let me say you why. So let's say we assume the market will go up and we are in between 316, right? So the premium for a 6 month uh, premium for okay, the premium for reaching this is 16, 12, right? So chances of 330 in 6 months is very less. So that's why it is uh, low. But the chances of let's say 300 is more likely. So the premium paid will be 41001500, and the payoff would be like that. What will be the any spot price? We will buy it at 300. If it is 320, then we will buy it at 300. Profit of 20 uh, into $2,000 like that. So that's why premium is high. And in the put case, you can see that we earn money by shorting the position. So let's say current price is saying 316 between this, and chances of 340 going is more, right? So let's say 25.45 is the premium paid, and that is of 100 shares, right? if if the price fall to 300, then the total profit will be 340 minus 300, right? Because it's the put, that is a k minus st, that is 40, and this will be the 100 now, right? $4,000, and $4,000 minus 2545 for around $2,000. That's why premium is high. And the low strike price doesn't make sense because we have to sell high, buy low. That's the logic. And for a call, it is sell low, buy high. That's the logic. And that's clear. So let's see the participant or of option, right? Option market. So we can, there is a buyer of call option, buyer of put option, right? There is a seller of call option, seller of put option. Seller earn money by premium, and they buyer earn money with the help of market. So it is premium, sorry, spot minus premium, you can say. Yeah, payoff minus premium, and it is premium. And now, let's consider what are the type of trader. There are hedger that hedge their position to minimize the risk. There is spec. Wait a second. Speculator that earn money by speculating that market will go up or go down, and there is arbitrager. So hedger example I give in oil and airplane with future and option both. And speculator, I will give the example in 1 minute. And for arbitrager, let's say there is a stock which cost arbitrager is like earning money without any risk. And to earning money from the incompetency of markets. So we in a mathematical finance we consider market as a complete market, which means there is a no arbitrage uh, possibility. But in real world, there is it's slightly incomplete market, and there might be some arbitrage possibility. But the funny thing about this, as many people know, the market correct itself. So let me say, if NSC some stock is at 70 and BSC it is 72, so you can sell this stock at BSC and buy it at NSC. So it is 2 rupees direct profit, removing all the brokerage and taxes for simplification. That is uh, arbitrage uh, opportunity. And then how the market will cover itself. As we sell this, many people sell this value will go down and it will be equal to 70 until nobody sell that point. So that is market correct themselves. So that is a hedging using. Yeah. So let's come to this speculation, right? So speculation means you are speculating or hoping that market will go up and you will earn money. So in table 1 for speculation using spot and future contract of 60 to 500, that is the cost, and the marginal cost is $20,000, right? So the thing is we have to buy uh, speculation is that the US currency will be weakened with time in 6 months, or a pound will be strengthened in 6 times. So the simple strategy that come into mind is, you can buy 250 two 250,000 pound at the spot exchange rate of 1.22 USD, and it will take investment of 305,000 dollar, and the profit if the spot price is 1.3 is 19,000, and loss is 5,500. On the other hand, you can use the forward contract in this, that at the forward price of 1.223, and the initial investment of $20,000 only. So we will buy 4 contract, and the margin for one contract is $5,000, I guess, and that's why $20,000. And if the spot price is 1.3, the payoff is $19,000, and if it 1.2, the payoff is five $5,000. The basic difference between the both is that in order to uh, earn profit directly, we need heavy capital of $305,000. On the other hand, we only need $20,000 for a future contract. So that is feasible, and we can do that. And now we will see of option. So comparison of a two alternative strategy using 2000 to speculator stock worth 20 in October. So it is October in 20 and this is December price. If it is 50 worth of $20,000, the loss is uh let's say my $500,000. It is 27, so profit is 700. But on the other hand, if we buy a option worth of 2000, that is 100 divided by 20 option, 100 divided by, yeah, 20 option. uh, if we lose, then we will lose all, and if we win, it is $7,000 more times 10 times of the payoff. But the thing is, we call option as a double-edged sword, because uh, it can earn you more, and it can put you in debt more, even more. So you can hurt yourself using option. So that's the thing. And I think I completed all the basic part. I think I completed all the basic part of the video, and I hope you like this video. And wait a minute, I hope you like this video. And yeah, this was all the basic of derivative option and future financial market. And I will continue making video on every chapter of this book. Until then, thank you for watching. Have a nice time. Bye.